Good evening, everyone. By way of introduction, my name is Hugh Wedlock, and I'm Director and CEO of the Fry Group here in Singapore. And I'll be your host as we unpack the spring budget for 2023. There's been significant change across a number of areas of the tax landscape announced by Jeremy Hunt on the 21st of March. And that's reflected in the agenda that we've got for today's session. Here it is. So we're going to look at the background to the announcements in the spring budget. We're going to look at the actual changes within the budget, both from the perspective of personal and business taxation. We're going to look at some other announcements that were in the statement. And we're also going to look at some measures that were previously announced by HMRC prior to the point that Jeremy Hunt got up on his feet. Then we've got some key takeaways. Now, we've got our own taxman running through all those bits of the agenda. Our taxman being Peter Webb, our head of international tax, who many of you will already know. Peter will take us through all those parts of the agenda, and then he'll hand back to me for some Q&A, which I'll then facilitate. If you have any questions during the course of the presentation, then please feel free to put them into the bit of the Zoom screen for Q&A, and we'll try and answer as many of those as we can prior to the end of the session. We're expecting today's session to last in total around about 1 hour. So just before I hand over to Peter, I'm going to try and get your grey cells moving a little bit with a poll question, which should come up any moment now. Now, that poll question, I'm hoping to see it on my screen any moment now. The poll question is a little...
Apologies to you, the poll won't come up at the moment, so maybe if we just want to ask it out loud, sorry about that. That's
fine. Okay, thanks, Poppy. So our poll question was a little bit of a cheeky question, really. But what we were going to ask you was, can you think how many chancellors of the Exchequer we've had in the UK in this Parliament? So since 2019, when Boris Johnson won the election in that year, how many chancellors of the Exchequer have we had? Well, there's been quite a lot of change. And many of you will probably know that in just 4 years, we've actually had 5 chancellors. I'll run through them for you. We've had Javid, Sunak, Zahawi, Kwarteng, and Hunt. So there's been an awful lot of change. It's been an interesting time. I don't think we've got a single Nigel Lawson in that list, have we? But there we go. So with that, I'm going to hand over to Peter to run through the body of the presentation, and I'll be back for Q&A. Peter, it's over to you.
Thank you very much, Hugh. I think that's one of the cheekiest kind of questions that we've actually asked you. And surprisingly, not many people got that right in our first session. All right, so a bit of background. Although it wasn't billed as a budget, the Chancellor's previous fiscal statement on 17th of November 2022, 5 months ago, was more of a budget statement than many budgets I've seen. And bear in mind, I'm actually really old. I've seen a lot of budgets in my time. So just 5 months later, we weren't really expecting to see significant further changes this time around. However, there were some really, really big announcements, not only for personal tax, but for business tax as well. So going back to November in the autumn, we saw a big increase in the amount of tax we're all going to pay. Now in the spring, 5 months later, Jeremy Hunt is now announcing that he's going to give us some of that money back. So how can he do that? What's actually changed? According to the Office for Budget Responsibility, the economy and public finances have proved far more resilient than expected in their kind of November 2022 forecast. Inflation, 10.1%. They think that's going to go down to 2.9% by the end of this year. And that's what's given Jeremy Hunt some room to maneuver. So where we're going to start is just have a look at some of these personal tax changes that were announced. And on this slide, I've picked out some of the more significant personal tax headlines for you from the budget statement. Now, please indulge me for just a little moment. On 22nd of February 1991, all of those years ago, Kenny Dalglish resigned as manager of Liverpool. Some of you will remember this. The world was shocked and stunned. Came completely out of the blue. Now, to me, the pension reforms announced in this budget were almost just as much of a shock and surprise as seeing Kenny Dalglish announce his resignation. And we're going to dig into those pension reforms in a little bit of detail in our next slide. Second bullet point here, this was a move that was very heavily trailed before the budget statement. Fuel duty remains frozen for yet another year. The last time fuel duty rose was actually March 2011. That's 12 years ago now. So 12 years without any rise in fuel duty. And finally on this slide, we have an announcement that charity tax reliefs will now only apply to UK charities and not European Economic Area charities as well. So UK tax reliefs and exemptions will be restricted to UK charities. For completeness, I'll mention community amateur sports clubs as well. This change was effective from 5th of March 2023, sorry, 15th of March 2023, and it applies to all taxes, and that includes income tax, capital gains tax, and inheritance tax as well. However, there is this transitional period until April 2024 for non-UK charities that HM Revenue and Customs had previously accepted as being available for tax relief. So Brexit has actually happened. HM Revenue are catching on to this now. I think what's interesting to speculate is will the right for European Economic Area citizens to benefit from a tax-free personal allowance when they're not UK tax resident be the next to go? And I think that that's really one to watch for the future. Okay, we're going to dig into some of these really significant reforms to the pension regime. There's this famous Flemish giant of a rabbit that I mention in a few of my webinars now. So it's a rabbit, but it's a massive rabbit pulled out of the Chancellor's hat. So the lifetime allowance, we're going to talk about that first. So what is the lifetime allowance for pension savings? So this is the amount of what I would call tax advantaged pension savings that you're allowed to accrue during your lifetime. There is a limit to that. Once you hit that limit, you can't accrue more tax advantaged pension savings. So that lifetime allowance is actually going to be removed. In the first instance, they're going to take away the charge that would apply for exceeding the lifetime allowance. And then from April 2024, the lifetime allowance itself is abolished. The reason for that little bit of a delay is the legislation is so complex that the government don't have any chance at all to sort all of that legislation out in time for 6th of April, or actually in time for the Act to receive royal assent, to be a little bit more precise. So they're going to delay that and give themselves time to trawl through the legislation, get all of those references correct. So what that means in practice for us is that we can now accrue pension savings in excess of the current lifetime allowance. And that current lifetime allowance is £1,073,100. Sorry, £1,073,100. I never ever get to say that right. Some people will actually have what we call enhanced protected lifetime allowance or fixed protected lifetime allowance amounts. But you will now be able to save pension funds in excess of all of those allowances. So then we think about what we call a pension commencement lump sum. So a pension commencement lump sum is the amount that you can take from your pension fund without paying tax when you first start drawing down money from your pension, when you first start receiving pension income. Historically, that's been 25%. 25% of your pension fund can be taken free of UK tax when you start taking your pension. Now, it's going to be capped at an absolute limit of £268,275. So it's going to be the lesser amount of 25% of your pension fund, or 268,275. And 268,275, when you do the maths on that, that's 25% of the current lifetime allowance. If you have these enhanced protections on your lifetime allowance, enhanced protection or fixed protection, you're going to be able to take 25% of that fixed or enhanced protected amount as your pension commencement lump sum. There's a further clarification here. That lump sum above the lifetime allowance, if you do go over the 25% or the limit that you have, there will be a tax charge, but it's going to be at your what we call marginal rate of tax, the top rate of tax that you would ordinarily pay. Previously, if you'd done that, there would have been a really penal 55% charge on what you'd accidentally taken perhaps over your allowed limit. So the removal of this lifetime allowance should also actually simplify the process for transfers to what we call QROPs, qualifying recognised overseas pension schemes. Previously, you would test the lifetime allowance at the point you did that transfer. Now, there shouldn't be that kind of test required. It could make it easier for you to transfer a pension overseas. Any future change in government could impact the practical implementation of this budget announcement on the lifetime allowance. And here I'm going to pause and emphasize this point. The Labour Party have already said it will introduce or reintroduce the lifetime allowance should it win the next general election. When will that next general election be? Probably looking at autumn 2024. I think at the very latest they could have it would be January 2025. And if you look at the polling today, I think you would see Labour with still a significant lead in the polls. So that is something to watch really carefully. Okay, lifetime allowance, pension commencement lump sum, we've mentioned those. So the next thing I want to mention on this slide is what we call your annual allowance. So what is an annual allowance? This is the amount that you're able to contribute to your pension fund each year and get tax relief. Yesterday, that annual allowance was £40,000. Today, first day of the new tax year, that annual allowance has actually gone up to £60,000. So there is a significant increase for you. And you're still going to be able to carry forward any unused annual allowance from the previous 3 tax years. Those are the previous rules, and those rules still apply. We have this thing called an adjusted income threshold that reduces your annual allowance. Previously, if you had salary and pension contributions of £240,000, you would see the limit you could make to your pension scheme gradually tapered away. Now that limit has now been increased to £260,000. Yesterday, you could the lowest limit that you would have when you reduce your annual allowance would have been £4,000. So it could be the case that for a high earner, you'd have a really tiny allowance for pension savings, just £4,000. Today, first day of the tax year, that's actually gone up to £10,000. And what that means in practice, that if you've got annual adjusted income of £360,000 or more, you will still have an annual allowance for pension savings of £10,000. Last thing to mention on this slide is what we call the money purchase annual allowance. So what on earth is that? What's the money purchase annual allowance? Well, generally, that's the amount of pension savings you can make if you're already drawing down pension income. Yesterday, that would have been £4,000. Today, it increases to £10,000. And the thinking behind this is hopefully going to encourage more of you who are taking your pensions to remain in work. Well, that was pretty intense, wasn't it? There were some really significant changes on the pension front for individuals. We're going to move on a little bit and think about some business tax changes. So it's not really our main focus for today, but we should mention because they were really significant. The introduction of the ability to fully expense corporate investment in new plant and machinery for the next 3 years does really soften the blow of an increase in corporation tax. So it had been previously announced that corporation tax would go up from 19% to 25% on 1st of April 2023. So that change has actually happened. So what we're now seeing is we're getting some relief for those corporates for their investment in plant and machinery for the next 3 years to try and alleviate that a little bit. And actually, when we think about that increase in corporation tax rate from 19% to 25%, I think one of the most common questions I'm asked as an advisor is, should I hold my buy-to-let property portfolio in a company structure? Is that better than holding it personally? Oh, goodness me, that's such a wide open question with so many different moving parts, and really not a lot of them are tax. Tax has a part to play, so many other considerations. But I think when we think about this now, an increase in corporation tax from 19% to 25% perhaps makes it just a little bit less attractive to hold properties, particularly in that kind of company structure. In addition, there were some further announcements for further tax relief for research and development for small and mid-sized enterprises. And again, that's really welcome in the business community. I think finally on this slide, in addition, it was announced that large multinational groups with headquarters in the UK are going to pay a top-up tax if their operations in a non-UK jurisdiction have an effective tax rate of less than 15%. That's a really, really interesting idea. I think there's going to be a lot of speculation as to how that's actually going to work in practice. We're going to move on and think about some other bits and pieces that were announced. First bullet point here. So I think there's a little bit of detail behind that really big headline that from September 2025, up to 30 hours of free childcare is going to be available for working parents. From April 2024, working parents of 2-year-olds will be able to access 15 hours of free childcare, first thing to say. Then, next part of the plan, from September 2024, 15 hours of free childcare will be extended to all children from the age of 9 months. Then, third part of the plan, from September 2025, working parents of children under the age of 5 will be entitled to 30 hours of free childcare per week. It was also announced that the sale of crypto assets are going to need to be separately reported on your tax return from the 24-25 tax year. Well, what's the thinking behind that? I think being really cynical, you would take the view that HM Revenue want to scrutinise the capital gains arising on crypto assets in a little bit more detail and understand the quantum of what's going on in that market. Capital gains on crypto assets can be notoriously difficult to report, sometimes simply because of the number of transactions that you can do with crypto assets over the year. So that's an interesting one for the Chancellor to throw in, actually. So picking up on this third bullet point, it had previously been announced that if you had a gap in your national insurance contribution record, the number of years you could make up with a lump sum payment would be capped at 6 years. And that was going to apply from 6th of April 2023. That's when the cap was due to come in. However, that cap has now been delayed, and that cap of 6 years in total will now only apply from 1st of August 2023. So why do you care about this? Why does this matter? Well, you're going to need 35 years of records of national insurance contributions to receive the highest rate of state pension. So you need to know if there's a gap in your record, and you need to know if you can actually make up some missing years in that gap. And I think I would also say that to get any kind of state pension at all in the UK, you're going to need 10 years of records of making national insurance contributions. So if you have any doubts about this at all, if you're worried about how many years you've been contributing national insurance for, then do look at that record sooner rather than later, because when we get to 1st of August, if there's a big gap in your record, you're only going to be able to make up 6 years. So the Chancellor also announced that the energy price guarantee is going to be extended for a few more months at the level of £2,500. And that's going to end at the end of June 2023. And then the cap on the energy price will be increased to £3,000. I think when you look at the price you're paying for energy in the UK, then any relief on that is actually going to be very, very welcome for you indeed, even if it's just for a few more months. So previously announced changes, what did we already know was going to change today on the 6th of April, the beginning of this tax year? In the autumn fiscal statement and in the spring budget, income tax rates weren't increased. But Jeremy Hunt is still going to make us pay more tax. So how is he going to do that? How does he make that work? Well, freezing allowances and freezing tax bands to set against rising taxable income over several years is a really stealthy, it's a really crafty way to make sure that we're all going to be paying more tax without actually raising that headline rate of income tax or capital gains tax. In November 2022, when Jeremy Hunt first announced this, Rachel Reeves, the Shadow Chancellor, described this as, I'll use her words, this is her statement, a conservative double whammy that sees frozen tax thresholds and double-digit inflation erode the real value of people's wages. That is her view. When I look at this, the real squeeze here is for middle income earners, and they're much more likely to see the amount of tax they pay increase more significantly. Why is that? Well, their wages increase will mean that they pay more tax at both the 40% and then going on to the 45% tax rate. When we look at the models on this, the highest earners are likely to see the lowest increase in the tax that they pay, even taking into account the reduced level at which the 45% tax rate actually bites. Moving on, dividend income. Kwasi Kwarteng, remember him, got a mention from Hugh a little bit earlier on. He wanted to reduce tax rates on dividends, but Jeremy Hunt has previously confirmed the current rates of 8.75%, 33.75%, 39.35% will continue to apply. But that is not all. Rather than dividend allowances being frozen, the amount of dividend income you're able to receive without paying tax is going to be reduced by 75% from £2,000 to £500 by the time we get to 6th of April 2024. The tax-free dividend allowance yesterday was £2,000, today it's £1,000, next year it's £500. So what does that mean in reality? If you pay tax at 45% and you have dividend income of £2,000, yesterday you didn't pay any tax at all on that. In a year's time, that £2,000 of dividend income is going to cost you £590 in income tax. Moving on again, we think about capital gains tax. And again, Jeremy Hunt has been really crafty in the way he's looked at this. He's found a very tricky way to pick your pocket and increase the amount of capital gains tax that you're going to pay. And how's he doing this? It's by aggressively reducing the capital gains tax annual exemption. The capital gains tax annual exemption is the amount of capital gains you can make each year without paying capital gains tax. By the time we reach 6th of April 2024, in a year's time, that capital gains tax annual exemption is going to be £3,000. Yesterday, it was £12,300. Today, it's £6,000. A year's time, it's £3,000. That's a reduction of more than 75% over yesterday's capital gains tax annual exemption. I would just mention it really does continue to be a surprise to me that the headline rates of capital gains tax, which are at historic lows, starting at 10%, have still not been changed in this budget statement. We're going to think about some other tax measures that were previously announced, and I've included some headlines on this slide for you. I'm just going to pick up on a couple of these. The first one is the inheritance tax nil rate ban. Generally, that's the amount that you can pass on free of a 40% inheritance tax charge to your intended beneficiaries when sadly you pass away. Now, once again, we see this really valuable tax allowance frozen. The inheritance tax nil rate band has not actually risen since the 2009-2010 tax year. If the inheritance tax annual exemption had risen in line with inflation, it would now be worth £494,000. And that would save you an additional £67,600 in inheritance tax. And I think that's a really good illustration of how you're going to pay more tax if allowances are actually frozen. Mentioned the residence nil rate band. The residence nil rate band is an additional inheritance tax allowance for passing on the value of your home to your direct lineal descendants. And that's going to be frozen at £175,000 as well. There are some conditions that you need to meet in order to benefit from that £175,000 additional residence nil rate band. I think the other point I would pick up on this slide is the national insurance contribution levels. If you're earning at lower rates, freezing the lower earnings exemption actually increases the amount of national insurance you will make at 13.25%. As your wages increase, more of those wages are going to be taxed at that 13.25% level. However, for the very highest earners, the freezing of those levels effectively reduces the rate of national insurance contributions that you're going to pay. This is because of future earnings growth will benefit from paying a lower national insurance rate of 3.25%. So the proportion you're paying at 13.25% reduces, and the proportion you pay at 3.25% increases, effectively reducing your headline rate of national insurance you pay on your earnings. Moving on, stamp duty land tax. At the moment, properties in the UK are now more unaffordable than ever, with figures released by the Office for National Statistics, another word I struggle with, showing that the average home sold in England costs the equivalent of 8.7 times the average annual disposable income, and that's as high as it's been. Severe undersupply of houses has really pushed average prices. I saw a figure from the Halifax a couple of days ago that was £294,260. I think the OBR, the Office for Budget Responsibility, had it at £296,000. And that's despite economic uncertainty and what we think are tightening buyer budgets. So what's our experience of stamp duty land tax? What have we actually seen? What we saw in the pandemic was that reducing stamp duty land tax increased house prices. I think we can only wait and see what's going to happen to the UK housing market over the next couple of years and what effect reducing stamp duty land tax charges will actually have. Okay, thank you for bearing with me this far. I think what we're going to do now is move on a little bit and think about some of the key takeaways for today. So what are my key takeaways for today? First thing I'd say are those really significant reforms to pension savings. You should consider whether or not you are now able to make pension contributions to pension funds previously caught by lifetime allowance limits. You also need to bear in mind that you have an increased annual limit for pension savings that applies from today. Other things to mention as key takeaways, there's a little bit more help for the energy price guarantee, and any relief for energy costs is actually very, very welcome indeed. Other things I would mention are that charity tax reliefs are now restricted to UK charities only. Bear in mind, we've got a limit of, or a deadline of 1st of August 2023, where you may be able to make up more than 6 years of missing national insurance contribution limits. Bear in mind that that limit of 6 years will then apply from 1st of August 2023. And I think the final comment I'm going to make here is that the amount of tax we pay is increasing and it will increase further. So what you need to do is consider strategies to protect yourself from rising taxes. Okay, so at this point, before I hand over to Hugh, who's going to facilitate our Q&A session, I was hoping that we'd be able to ask you a question. So I'll just check that we can actually do that. I think we might be having one or two technical hitches. Oh, it's come up. So great. So what do you think this budget does for your own personal financial position? So I've asked, does it make it better for you? No significant effect, or does it make it worse? What do you think? You can vote now. I'm going to be really interested to see what you have to say about this one. Okay. Actually not seeing anybody vote on this one. I'll just give it a couple of seconds to see if anything changes on that. I suspect, oh, wow, we do have some answers on this one. Great. Well, makes it better, 10%. This is a little bit bigger sample size than we had a little bit earlier today, when it was around about 19%. So 10% of you think it makes it better, 26% no significant effect, but makes it worse 64%. Goodness me, that's quite an astonishing result. So we don't think the budget is generally good news. And on that note, I'm going to hand over to Hugh, who's going to facilitate our Q&A session.
Thank you, Peter. Let's see if we can get everyone feeling a little bit better about things than that poll answer might have indicated. I particularly like the revenues forecast for inflation later on in the year, 2.9%. I think that's either going to prove to be very lucky or wrong. So, Peter, we've got some time for Q&A.
Yeah.
And we'll crack on with a few bits, and we're going to start by talking about personal taxation and funding into pensions, because there has been some huge change from the perspective of pensions legislation. Just to recap, the lifetime allowance, that limit that was put on me in terms of the total amount I could put into a pension pot during my lifetime and get tax relief on it, was completely gone. The annual allowance, which limits the amount that I can contribute into my pension pot year on year, has changed from £40,000 to £60,000 per annum, if I have the net relevant earnings to justify those. And the money purchase annual allowance, which effectively enables me to recycle funds from my pension pot if I've started drawing down income and put it back in again, that's gone up from a minimum of 4 to a minimum of 10. So very big changes, and I guess the question is, does this give me significant scope to improve my personal tax position with additional pension contributions if I'm either a UK tax resident or I have net relevant earnings in the UK?
Yeah, that's a great question, actually, and there are many different moving parts to this. What I would say is, from a tax perspective, pension contributions, pension savings are actually really quite tax efficient at the point at which those pension savings are actually growing and at the point you make the contributions. So if you are earning in the UK, the ability to have more funding for a pension is going to help you. You're going to get tax relief for the amount that goes into the pension, and you may be able to reduce the amount of taxable income that gets shown on your tax return as well. So that's great news. The pension fund itself grows free of income tax, free of capital gains tax, and is protected from inheritance tax. And that's really, really important. That's probably the biggest tax liability that's hanging over you. So from a tax perspective, getting funds into a pension scheme is going to help you on the way in and as it's growing. Where you will see the tax charge, that kind of the con for this, is when you take the money out of the pension scheme. First thing to say is there could be a restriction, could be 57 before you're able to access the pension scheme. That's the compromise you're making for the tax advantages. And you're going to pay income tax on the money coming out of the pension scheme. But generally, you're going to be taking that income out of the pension fund perhaps later in life when other sources, such as your employment income, have actually ceased. So that could still be quite efficient for you. As a general comment, I think what you need to do is understand what your goals and aspirations are in terms of your retirement planning, the wealth that you're going to need to generate to fund your retirement living. Hugh, do you have any sort of general comment on retirement planning and pensions that you would actually add to that?
Well, I think what I'd say, Peter, is that pension saving can go alongside all of the other either tax beneficial or tax relieved wrappers that are out there. And I'm thinking about things like ISA, enterprise initiative schemes, alongside pension funding. But of course, I'd come back to the point that you can only make ISA contributions as a UK tax resident. EIS is something that non-residents can access and get tax relief on if they have taxable income in the UK, whereas pensions is down to both your residency and whether you have NREs. So really, it's net relevant earnings. So it's a good idea to be getting some advice in those areas, or to have a holistic approach. Let's go back to the pension funding again, Peter. So what if I'm not UK resident, but I have UK work days? And also, what if I'm already taking money from my pension and I want to recycle some of that back into the existing pension fund that I have? How does this affect things?
Yeah, absolutely. So if you're not UK tax resident, it's a really good idea to speak to advisors to work out what you can do. If you're not UK tax resident, but you're working in the UK, it could well be the case that you have some UK taxable employment income, even if you're not UK tax resident. But you do need to be careful about this, because sometimes there is relief available from a UK tax charge under the terms of a double taxation agreement. So although you may be working in the UK, you may not have those net relevant earnings. So that's the first thing to decide. Do you have taxable employment income in the UK? Then the next thing to decide is, if you do, are you still able to make pension contributions to a UK pension scheme? And there are rules and limits around that that are different for non-residents than for UK tax residents. And generally, if you're not UK tax resident, you're only allowed yourself to contribute to a UK pension scheme in the first 5 years of being non-UK tax resident. That's a general rule. You do need to understand how those rules will apply to your own specific circumstances. But it could be the case, and again, some complexity here that needs to be looked at for you. It could be the case that your employer might be able to make a contribution to a pension scheme for you. So for those non-UK tax residents, it's complicated. You may be able to make the pension contribution. You need to speak to advisors to work out if you can do that. And you certainly need to speak to a financial planner to work out that if you can do that, should you do that? I can tell you the tax rules, but it's Hugh who can tell you that that's actually a good thing to do. When we think about the money purchase annual allowance, so we mentioned this a little bit earlier. So this is the allowance that applies if you're already drawing down pension income. If you're not drawing down pension income, you have earnings, then you have an annual allowance limit of £60,000. But if you are already drawing down pension income, you may be earning, but your allowance for putting money into a pension then becomes £10,000. This is to stop you kind of recycling pension income back into another pension scheme and getting further tax relief. But it's £10,000, it was £4,000 yesterday, £10,000 today. So if that is you, perhaps you're later in life, you're still working, drawing down a pension, you are still able to make perhaps not insignificant pension savings. Does that answer the question, Hugh?
It does, Peter. I think that's enough on pensions for now.
I think it is.
We'll get on to some taxation of businesses. And one thing that a lot of our clients ask us, particularly the clients who have significant exposure to the UK property market, is whether they should hold those UK properties via a corporate wrapper of some sort. There's a number of motivations behind that. Might be some sort of mitigation of income or gains, could be something to do with estate planning and being able to pass those properties in a slightly more liquid, perhaps gradual way by gifts of shares in a company. You mentioned that potentially these changes make that facility slightly less attractive. Do you want to just give us a bit more detail there?
Yeah, absolutely. It's probably easiest to illustrate the income tax versus corporation tax picture here with maybe a couple who are not UK tax resident to make it really simple. So you have a couple who are not UK tax resident. They don't have any sources of income in the UK apart from UK property income, and they're both entitled to a tax-free personal allowance. So you've got a couple, they own properties jointly in their own names. They're both entitled to tax-free personal allowances, no other income. They would, if they earned £100,000 in profit from their properties, they would pay income tax of £15,000, an effective tax rate of 15%. That same property income arising in a company would now be taxed at 25%, and on that £100,000, you would pay £25,000. This is because it's going to be what we call an investment company rather than a trading company. So all the profits are taxed at that new rate of 25%. So just as your headline, it doesn't usually make sense to hold buy-to-let properties in a company. However, there can be non-tax reasons for doing this. Perhaps one of those non-tax reasons is that you want to retain control of the properties, but be able to pass on the investment growth in those properties to perhaps the next generation.
Mm-hmm.
If you hold the properties in your own name, there has to come a point where you're going to perhaps gift the whole property to your children. That's quite a binary thing. You lose control of the property, you need to survive 7 years to make that effective for inheritance tax, and you can't retain any income from the properties either. And your children are then free to do whatever they want with those properties. I'm not saying anything about your children. If it's actually held in a company, what you may be able to do with some careful structuring is to ensure that with children as shareholders, parents as shareholders, other family members as shareholders, is that control of the company, control of the properties resides with parents, but actually the investment growth, the capital growth on those properties, all of that at 40% is actually arising in the hands of your children. And that can be really quite clever. It can be quite a clever way to begin to pass on wealth to the next generation and still retain control of those properties, maybe still retain a bit of income from those properties as well. It's a very, very individual discussion. It's a very individual set of circumstances that we'll look at for you, and we can talk through the pros and cons. Usually there aren't any kind of black and white, right and wrong answers here, but we can get you a best scenario with thinking about, should you hold properties in a company? I think I've probably said enough about that now, so I'm going to hand back to Hugh on that one.
Thanks, Peter. We haven't talked about IHT much today, or inheritance tax, or estate planning much today. No changes to inheritance tax announced in the spring budget. Do you think that might change in the near future?
Yeah, that's a big surprise actually. For a few budgets now, we've been expecting some significant changes for inheritance tax. Back in 2019, they were talking about reforming inheritance tax, and that didn't actually happen. There was a parliamentary committee that suggested that. The now defunct, I think, Office for Tax Simplification suggested that as well. So I think what could change? I think what could change is that there's a whole slew of different tiny little tax reliefs for inheritance tax. There's an annual allowance for inheritance tax, £3,000 or £6,000, depending on circumstances. There's allowances for marriage, which could be £1,000 up to £5,000. There's a tiny little annual allowance for basically birthday gifts and Christmas presents of £250 a time for people you give money to. I think what could happen, what would be very easy to do, would be to take away all of those tiny little kind of annual exemptions that you can benefit from and just make it one simple annual inheritance tax allowance that you benefit. And it could be maybe £10,000 or £15,000, something like that. And I think inheritance tax is really quite complex, and there are some really complex reliefs that apply. There's a very specific one for the value of agricultural property that's passed on to intended beneficiaries. There's another one for passing on the value of a business to intended beneficiaries. And both of these are really quite complex. And I really wouldn't be at all surprised to see that quite drastically simplified in future budget statements. Other bits and pieces, well, perhaps some of those reliefs could simply be abolished as well. So I think simplification, reduction and abolishment of some of those allowances is really what I would, or allowances and reliefs, is what I'd be expecting to see.
Okay, thank you, Peter. We'll round off by asking you to look into your crystal ball and sort of try and get a little bit of a steer for you in terms of what a Labour Party government might do if it got into power. They've talked a lot about ending the current tax regime pertaining to non-domiciles, equalising capital gains tax with the current income tax levels, and perhaps even re-implementing the lifetime allowance charge, which we've just seen the back of. What are your thoughts there?
Yeah, so you think about that next general election, autumn 24, January 25 at the latest. You look at the lead in the opinion polls at the moment. Is there going to be a Labour government next? Well, if you were to run the poll today, I think it's quite a likely outcome. So we do need to think about this. After the autumn budget statement, Rachel Reeves, the Shadow Chancellor, said she was appalled that the government didn't close what she called the non-dom loophole. So non-UK domicile, what does that mean? So somebody who's not UK domiciled, the UK isn't their home country. It's quite complex. I won't get into the definition. But if you can say you're not UK domiciled, then your liability to that 40% UK inheritance tax charge is limited to UK assets only. Assets outside of the UK are outside of the scope of that 40% charge. If you think about that, that's a huge advantage to being non-UK domiciled. In addition, a non-UK domicile who's living in the UK, they don't have to tax their overseas income, their non-UK income, and non-UK gains in the UK either. These are really big tax advantages. At the moment, those income tax and capital gains tax advantages kind of they're efficient for you perhaps 7 years in the UK. Inheritance tax, we know that for a non-dom that expires at the absolute outer limit of 15 years of residence in the UK. 15 out of 20 years, you lose that status. So what I could see really easily happening is that 7 years for income tax and capital gains tax, 15 years for inheritance tax. Those limits could be really brought down to perhaps, I don't know, speculating, maybe 5 years or something like that. That'd be very easy to implement. Other things that could happen, we know the Labour Party have stated, this is what they've stated, is that they would like to tax inherited wealth. They want to promote entrepreneurship, but they want to tax people who actually inherit wealth. So how are they going to do that? I think that is some perhaps quite significant reforms to inheritance tax. I would expect to see that. They've already said they're going to reintroduce the lifetime allowance on pension savings. So again, that might be something that we would see implemented really quite quickly with a new Labour government. And yeah, finally, capital gains tax. When I started in tax, which is way back in the dim and distant past, capital gains tax was at the same rate as income tax. We have historic low capital gains tax rates at the moment. Could capital gains tax go back up to the same rate as income tax? It's a possibility too. So I think I'll leave that one there, Hugh.
Peter, we'll round it up there for the Q&A. I'll say thank you very much for all your input as usual. Excellent presentation. Thank you very much. So I will close off today's session with a few words about the Fry Group. Many of you will have seen one or two of these slides before, but as a reminder, the Fry Group are a UK headquartered financial, tax and estate planner, and we were founded in 1898. Our mission, if you like, is to provide our clients with financial freedom. And we appreciate that means different things to different people. And we have offices in all of these jurisdictions that you can see on this slide here now. Hopefully in a moment you will see our contact details in all of those offices. There they are. Please feel free to get in touch with us, even if you just want to know a little bit more about what we do and how we operate day to day. It only remains for me to say thank you very much for joining the webinar today, and enjoy the rest of your day. Thank you very much. Bye-bye.